The following is a sample from Tax Savage's Basic Tax Preparation course.
We'll start with student loan interest. Congress decided that it's in the nation's best interest to have a well-educated population. So, they structured the Internal Revenue Code to allow a number of education-related tax deductions, including the deduction for student loan interest. Individual taxpayers are allowed to deduct up to $2,500 in interest and qualified student loans for themselves, their spouses, and their dependents. The maximum is the same, regardless of the number of students in the family. The IRS doesn't want to be too generous, you know? The deduction is claimed as an adjustment to gross income on Form 1040. This is not to be confused with other types of interest which are deducted by itemizing on Schedule A. The student loan interest can only be claimed by the person who took out the loan and is legally obligated to pay it back, not necessarily the person who received the educational benefit. Often, parents will take out student loans for their children. So in this case, the parent would get the benefit. The student normally takes out Stafford loans, while PLUS loans are made by the student's parents. To qualify, the student must be the taxpayer's spouse, or someone the taxpayer claimed as a dependent in the year the debt was incurred. Any kind of loan can qualify, including interest on a credit card that was used exclusively to pay qualified educational expenses. However, the money has to be borrowed commercially. A loan from a relative doesn't count. In this context, related persons are spouses, parents, children, and their descendants, and any siblings. Lending institutions that issue student loans will send Form 1099-E to qualified borrowers each year by January 31st for the previous tax year. To be eligible, students must be enrolled in at least half-time in an academic program leading to a certificate or other recognized credential. In addition, the proceeds of the student loan must have been used exclusively for qualified higher educational expenses at an eligible educational institution. In addition to typical college and university courses, internships or residency programs offered by a hospital, healthcare facility, or institution of higher learning are also considered eligible as long as they lead to a recognized degree or its equivalent. Military academies qualify as well. The student doesn't need to have completed a degree program for the expenses to be deductible. Someone who is claimed as a dependent may not claim the deduction in the same year they are listed as a dependent. The deduction also can't be claimed by a taxpayer who files as married filing separate. But if the parents can't claim the exemption because of income limits, for example, then the student can claim the deduction. Let's drill down a little deeper here and discuss education expenses and what can or can't be claimed. Qualified educational expenses are defined as the cost of attending an eligible institution and includes the following: tuition, course-related fees, room and board, transportation, books, supplies, and miscellaneous student expenses. Qualified expenses may be reduced by certain non-taxable benefits like academic grants, tax-free scholarships, employer-provided educational assistance, U.S. savings bond interest used to pay educational expenses, earnings from qualified education savings, and so forth. The qualified expenses must have been incurred within a reasonable period of time before or after the debt, or student loan, is assumed, and must also apply to a period in which the recipient was an eligible student. So, if they took out a loan, quit school, and blew it on whatever they wanted, then it's not a qualified expense. It happens a lot, so make sure to ask when they were a student and when the expenses were incurred. Most frequently, you'll see that they take out the loan just before or after the school year starts and will spend most of it around the same time while they're preparing for school, and this is expected and okay. Another deduction for education is tuition and fees. The cost of qualified tuition and fees can be deducted as an adjustment to income. Don't confuse this with the educational credits as an either-or situation. It can be deducted as an above-the-line deduction. Eligible taxpayers can claim the yearly amount allowed by the IRS for qualified educational expenses, which will be dependent upon the taxpayer's modified adjusted gross income and filing status. The deduction is claimed on Form 1040. If you use Form 8917, you can generally claim the tuition and fees deduction if all three of the following circumstances apply. The taxpayer does not file as married filing separate. The debtor paid qualifying higher education expenses for an eligible education institution. They were paying for an eligible student and the eligible student was a spouse or dependent for whom the taxpayer claimed deductions. On the bottom of Form 8917 is updated circumstances, and these change from time to time, so make sure to update yourself on this or let the software guide you with interview mode. When looking at students, other non-deductible expenses can include insurance premiums, medical expenses, room and board, other personal or family expenses, student activities, athletics, unless it's part of the degree program, and transportation. The student should receive a Form 1098-E tuition statement from their school, and it should clearly list the expenses and tuition. And by the way, if you were wondering, an eligible institution is defined as any college, university, vocational school, or other post-secondary educational institution eligible to participate in the student aid program administered by the Department of Education. If you have any questions regarding eligibility, you should address them to the institution, and they'll be able to tell you if they qualify. Generally, this isn't an issue, but sometimes people get scammed and they can't even claim the deductions. Most of the time, though, they can't even get a student loan if the school doesn't participate in the student aid program. Now, if your client paid part of the qualified education expenses with certain tax-free funds, that portion of expenses can't be claimed in a tuition and fees deduction. Example of tax-free funds are the tax-free portion of scholarships and fellowships, Pell Grants, employer-provided educational assistance, and veterans educational assistance. Any other non-taxable income like gifts or inheritances also apply here. No double dipping is allowed in claiming tax benefits, including the tuition and fees deduction. The same rule applies with most grants and credits. The taxpayer may not claim the tuition and fees deduction if those are the same expenses already being paid for by a lifetime learning credit or interest paid with tax-free interest from a U.S. savings bond business expense for work or related deductions.
This was a selected clip from our course on basic tax preparation training. For more clips like this one, subscribe to our channel or go to taxsavage.com, where you can see our professional tax preparation software that includes this entire course, a $396 value for free.